Welcome, everyone. Thank you for joining us for our Austin Energy Green Building webinar, Austin Real Estate Trends. Before we start, we have a few announcements. Taj, can you put up the first announcement? All right, if you haven't heard, the Austin Building Technical Codes have been updated and they went into effect September 1st. Check out the City of Austin's website to learn more. And we're going to post the direct links for all these announcements in the chat. So Taj will put that up there just a second. Next announcement. We have the AIA Austin Homes Tour this weekend. And this year's tour includes a hybrid of in-person visits and online presentations. So visit their website for more details. And we've listed the folks that were chosen for this year's tour. So congrats to all of them. And check out their website for more information. Right, the next announcement. We have the Hemp Building Summit, and that's October 29th through 30th, and it's being held here at our own Austin, Texas Central Public Library. Check out more details, and they've also provided a discount code there. We will send out these slide decks in case you need that information later so that you can use that discount code for tickets. All right, the next one. So the Austin Green Awards is coming up on November 3rd. This event celebrates projects demonstrating excellence in green building and design. And this year it's an in-person event and there is limited capacity. So check out the details for that on their website. Next. And we have a listing here of our upcoming events. We are postponing the tour of the new Austin Energy headquarters until we resume hosting in-person events again. And then our next virtual webinar will be in December. It'll be December 14th, and we'll cover lighting strategies. On January 11th, we'll have a review of the IECC code updates. And then we're also starting to plan our next year's events. So we'll be sending out a general survey about our educational events and also giving you the opportunity to vote on seminar topics. So look for that email sometime in November. All right. And we are offering continuing education credits for AIA, GBCI, and AICP. The submissions are in review right now, so the certificates will be sent after they're approved, and the certificates are sent to folks that attend the entire session. Okay, and during the presentations, if you guys think of any questions, please submit them in the Q&A. And if you need to indicate who you'd like to answer the question as well, it will probably be obvious, but just in case. And then we'll try to answer all your questions in just the panel portion, which is at the end of all the speakers' presentations. All right, Tricia, take it away.
Today, our panelists will discuss Austin's growth and the effect of the pandemic that the pandemic has had on the Austin market and which trends will influence Austin's future. The speakers will review the economic outlook, the impact on industry sectors, and recovery scenarios. They will also highlight trends and development that contribute to strong, vibrant, and culturally rich and diverse neighborhood districts. Our first speaker today is Mark Sprague. He is a State Director of Information Capital at Independence Title Company. Mark has been with Independence Title Company for 12 years and is a respected analyst in the real estate and financial industries and the Austin market in particular. He has been consulting in multiple industries and channels for over 40 years. He has a bachelor's degree in journalism from the University of Texas at Austin. So Mark, we've had a lot of growth in Austin. What can you tell us about the state of the economy and the impact on the building industry?
Well, if the audience doesn't realize we're in one of the best markets in the world, not just the nation, but the world, I don't know what they're watching because during COVID, I mean, we had two large announcements, Tesla and Oracle, and they actually weren't announcements for y'all that are not aware of that. It's interesting. Both Tesla and Oracle were part of their 10K stock announcement. And so in that, as the reporters, financial reporters are looking at it, they go, hey, look, it says here that you changed your address to Austin from San Jose, Oracle. And they went, oh yeah, we're moving our headquarters there, and didn't go into any more than that. So for those that think that both Tesla and Oracle bring a lot of employees here, that's not as true as it used to be in the past when we would hear IBM and others announce. We're a highly educated market, or the fifth highest educational attainment of all major metros in the United States. Washington, D.C. is first, second is Boston, San Jose and San Francisco, then Austin. And so they feel that they can acquire the talent that they want here. But that said, I speak all over the state and all over the nation, and I can tell you for a fact that I don't know of any other metro that had those type of announcements last year. And if you've never heard me speak or not aware of my reputation, I tend to be very conservative. My company and my friends, my clients call me Dr. No, Mr. Negative. That said, I don't see this market slowing down for quite a while. And what we saw during COVID is we saw basically compression of all the trends that were coming down the line, whether it was retail, whether it was construction, whatever it may have been. And one of those was desirability. One of the falsehoods that's going out there presently is that we saw a bigger influx of migration last year. We didn't. It's the same amount of migration we'd seen previously. The good news is we're still creating between 35 to 40,000 jobs a year. It was condensed. People sitting at home either decided to move up within their homes, remodel or sell their homes, or move from other markets. I know everybody wants to blame the Californians for the prices. The main thing that happened last year, we only had about 3% migration from California, 3% from New York. The main thing that happened last year is we saw personal savings go from $2.5 trillion to just under $10 trillion. And for you all in the audience that are going, yeah, maybe trillion, don't mean to make you suffer, but let me explain something. 1 million seconds is 11.5 days. 1 billion seconds is 32 years, some odd months and days, and 1 trillion seconds is 32,780 years, some odd months and days. So when we get to trillion, it's a whole different industry. And people go, well, why do we have such a jump? Well, people weren't going on trips, people weren't going out to eat. And that obviously, they weren't shopping as much. I don't know how many of you bought any type of dress clothing last year. Obviously, what sold last year was what I call soft pants, gym shorts, sweats, athletic shoes. You didn't see the typical shoe sales and such that you saw historically. And a great example is the owner of the shoe hospitals across the state. At one point, I think for 6 months, his business was off 70%. So it had a great effect, compressing certain trends. I will tell you, as a nation, we knew that we can never tell you when a recession is going to happen, but we knew we were going to have a recession. We had the longest run positively, 127 plus months. And what we didn't expect, for y'all that didn't realize that we had a recession last year. Now, normally the definition of recession is 180 days of negative gross domestic product GDP growth. We only had 2 months of negative GDP growth, but it was pretty gruesome. We dropped the lowest we've ever been. If you're not aware, we saw oil, West Texas Intermediate, WTI, oil hit negative 32 on the futures market. And we just saw a number of things in March and April. You know, it's interesting because we typically go through about, 28 to 35% of all listings residentially. Commercially, we go through about 20% of all listings. And by June, we bumped up to 45%. By August, we're at 95% of all listings. So and not just Austin, we were seeing that in Dallas-Fort Worth. We were seeing that in San Antonio. Houston was the only one lagging, but the reason it was lagging in Houston because in 2020, not because of COVID, but because of the oil wars, you saw lost 380,000 jobs, which is more than in the previous downturn in the late 80s. So all that cause values to go up and go up dramatically. Now we, as a 5-county area, really didn't see double-digit appreciation. We were just underneath that. We're at about 9.7. But one of the more interesting things we saw last year was, if I look at price channels, breaking down below $1 million into 200,000, the price channel that got the most appreciation was above 2 million, and it got 47.8% appreciation. And that was true supply and demand. There's not enough product in that price range for the people that were looking. And we saw some large sales, et cetera. But that was a surge. And I'll tell you what I told luxury realtors last year, both in Dallas and Austin. I said, you're stealing from the future for today's sales. And that's what's happening. So the spurt we saw last year in values as well as sales was, I believe, a one-time spurt, but we'll still see values continue to be fairly robust through probably 2024, 2025. At that point, we'll begin to see the builders and development catch up. We're about 7,000 total units in Austin short of for sale. But we also did not have enough shelter going into this. So we're actually short on apartments. We're still at about between 92 to 94% occupancy, which is unheard of. We did see rents on apartments slow down for a short time last year, but they will go up dramatically over the next 2 years, just due to the strength of the market. So be aware of that. The other trend we're seeing here is we're seeing more, and it's not a great portion of the market, but we're seeing more build to rent from the big builders where they sell out whole communities to groups that primarily institutional money. And so that will go forward. If you're not aware, material and labors have gone dramatically up, and that's something that we predicted. We didn't see the supply chain issues, but right now, your cost for materials and labor are going up about 3 to 4% a month. Do the math. So yes, I would say that your hard costs are definitely going to go up between 25 to 40% annual. People go, how can that be so? Well, you saw lumber spurred last year. It's still not gone down to what it'd been the previous 10 years, between 300 to 400. It's at about $800 a 1,000 linear feet. And we're not going to build more sawmills. It makes no sense to build more sawmills or any type of factory like that at this point. And I'll explain that if anybody wants to know about that. But so I don't see those costs coming down anytime soon. What's happening globally, if you're not aware, you have a number of factories, about 35 to 40% of factories in South Vietnam are closed due to COVID right now. You have a number of factories closed in China, and all these have bits and pieces of our cabinets, our everything. And one of the more interesting things is watching the last year, our ore has been fairly safe, but in the last probably 90 days, it's gone nuts where rebar, roof nails have gone up about 6 to 8 times what they've been in the past. So they're almost like gold right now. They're hard to find. You definitely can't order them. I'm sure everybody's aware that we're going to have paper shortages again, not just toilet paper, but probably your office papers and such, because a lot of it is caught offshore. Again, no more new mills have come online. But where do I see Austin going from this point? I think that we'll continue to see fairly robust growth because we have so many corporations looking to Austin to move here from either coast. You will get a copy of my typical PowerPoint presentation. And one of the things that you'll see is housing permits. And housing permits are off 83%, and Chicago the last 10 years. Housing permits are off 58% in Atlanta, and I can go on. The only cities that are above where they were 10 years ago in housing permits are going to be Austin, DFW. Austin's about 24% ahead of permits. DFW's only 2%. By the way, Austin is the only metro in the top 50 that is recovered every job lost from last March and April. We're at 103% recovery. I believe we lost 168 to 170,000 jobs, and we've fully recovered beyond that. Now, one of the interesting things that we see presently is the lack of qualified personnel in any industry. And I was in one of our management meetings, and they're complaining because they could not get their lunch order.
Yeah, I got it.
And and they looked at me and said, "You're smiling." And I said, "Go on. What are you getting ready to tell me?" They said, "Yeah." They said didn't have the personnel. And they're, I'm not going to tell you the restaurant, but I said, "No, that's pretty much right on." And they said, "Well, is that going to be resolved?" And I said, "No, but that's good for business." And everybody in the room said, "How can you say that's good for business?" I said, "That will continue to attract job seekers for the nation to Austin." So again, we will be in a fairly robust market for a while. I don't, we had two major
Right.
Yeah.
last year. So that said, I don't see it slowing anytime soon. I mean, we had the snowstorm that obviously kept us all in our houses. And by the way, viruses was not on anybody's radar. That was what happened in books and movies. Each of your specific neighborhoods will continue to see a fairly robust appreciation. You'll continue to see knockdowns. The biggest issue is going to be the length of completing those houses. Builders were, because we've been a conservative lending market, builders and developers did not have enough lots on the ground. And let me back up. In 2019, when I met with the analysts that watched that Metro study, Zonda and some of the others, we thought we'd have too many lots by the end of 2020. And instead, we didn't have enough lots, and obviously do not have enough lots going into the future. One of the interesting things that's happened, if you're not aware, all of us typically think if you move farther out, you're going to get a larger lot. Presently, to keep prices affordable in the $300,000 range, and we're talking out in Gerald, et cetera, you're now building on 40-foot lots about 100 feet deep rather than the typical 50 to 120, 150-foot lot. Commercially, gains, and Roland will discuss that later, but I've never studied a market, and I've done market studies across the United States, where I've seen every channel from ranches to warehouses being positive. Now, I'm going to stop on ranches real quick. Ranch sales completely stopped the first 6 months of the year. There was no sales. When I talked to Dr. Gallon at Texas A&M, he tracks that. He said there's no buyers. That's because of oil. But the second 6 months of last year, we saw values continue to go up as primarily baby boomers bought rural properties, maybe as close as Salado, as far as Kerrville, nothing over 500 acres, but basically just wanted someplace to get out of town. They did not move down. They did not move away. They bought a secondary house or tertiary house in these rural areas. So we saw that not only in Texas, we saw that across the United States when I talked to other analysts. Supply chain is going to be your biggest issue. I don't see values slowing because of that. When I talk to the supply chain guys, head of Black & Decker, head of some of the big paint shops, et cetera, and they're typically are conglomerates. Unfortunately, they're seeing their costs 20 to 40% variance, which obviously they're going to pass on. They are eating some of that. And that's whether it's a production builder or a custom builder or to Home Depot. So I don't see those costs slowing down because the number of factories are closed globally. And then even if they were open, we can't catch up to the demand that we're having presently. And it's going to take years to recover to that level. So it's interesting. We're seeing the current administration saying oil companies, you need to work 24/7, ports, you need to work 24/7. Well, the issue is not just in the United States, it's also overseas. So I see us continue to see costs go up dramatically for the next, as I said, 3 to 5 years. I'm trying to think if anything that I have failed to tell you all. Oh, and the thing I always tell people is people go, well, when will traffic get better? And my response to that is, you and I don't go to LA, to Boston, to London, to Beijing expecting traffic to get better. If your traffic ever gets better in the city that you're living in, your economy is slacking off. Your economy typically is not doing as well as it has previously because infrastructure never gets ahead of growth. Secondly, wages historically have never gotten ahead of growth. So when people say, well, these values, when wages catch up, I said historically that they never have. As I addressed earlier, affordable. I said affordable is just like it always has been. Yes, it's got more expensive to live in Austin, but affordability, $300,000 range was affordable before COVID. And all what has happened is it's moved farther and farther out. It's now north of Jural. It's now east of Hutto. I can go on, and that will continue to happen, just like it did. I've been doing this for 45 years. My first house was on the edge of town, and the edge of town at that time was just off of Kramer. North and south, there was Cherry Creek. Westlake was just where the cedar choppers and the art professors lived. So we continue to see a fairly strong growth. Dallas-Fort Worth will continue to see strong growth. San Antonio, Houston will take a while to catch up. But again, I believe we're in a fairly good market. And I'll be around for questions later, but that completes my portion of it.
Well, thank you. It just seems like it's a mixed bag. I mean, like all the good news of what's happening in Austin with our economy and growth, there comes, you know, the trade-offs of kind of affordability, like you said, gets pushed further out, and you know, this I guess in the long term, I mean, we're a vital city, but there's just some pain points along the way.
It's called life, and I don't mean that lightly. But you know, people say, well, that's just wrong that it's going up that much. And I said, and it's something you can't control. So you either got to live to deal with it. And I said, and that's, but I said, if values were stable, just flat, we wouldn't want that either. And we wouldn't want growth flat.
Right, right. So anyway, I guess it's just the next generation kind of has a different life in Austin than the previous one did, as it always does.
Yes.
Yeah. So I would like to introduce our next speaker, which is Gaines Bagby. He's first vice president at CBRE Incorporated. He's been with that company for 35 years and has been a licensed commercial real estate professional in Austin since 1983. The scope of his business is both consultative and transactional, depending on the needs of his clients. He provides his clients with strategic and often difficult to find information they need to make important real estate decisions. His focus is on facilitating the real estate process in ways that deliver value-added results to the bottom line in a timely manner. At CBRE, he was on the team that secured the transaction of the IBM manufacturing facility property to the Domain. It's a Austin Energy Green Building 3-star mixed-use development, and convinced AISD board to undertake an adaptive reuse of an industrial building that became Pardon Elementary, which earned a 4-star Austin Energy Green Building rating and LEED Gold certification. Gaines, a longtime advocate of renewable energy and green building, drives an electric vehicle and has solar PV on his home. Gaines is a graduate of Trinity University in San Antonio, majoring in marketing and media, and is a lead AP. Well, Gaines, we're in the second year of the pandemic. How has that impacted the commercial office market?
Well, thank you, Patricia, and I appreciate Mark's remarks before about
some of the statistics globally and on residential. CB is a Fortune 122. When I got here, was about a $250 million regional company. So it's grown quite a bit, and I stick around because all the tools that we have and continue to be cutting edge and helping our clients. Anyway, so we're going to talk about office for a while primarily, and see what's happening in office. There are some things going on in the office market that continually, almost every day, I have clients that ask me, well, it seems like that this should happen, or this would be happening in the office market as a result of the pandemic and the resultant recession, as Mark said, which, by the way, for everybody, if you don't already know this, you probably do. This is 100% medical. So there's nothing in the economy that was bad. There's nothing that is bad. There's some supply chain problems in that have been caused by this, but this whole thing is medical. Once everybody figures out that that it's safe and comfortable to get back to the office, we'll be back. But let's go through a few things, and it may take a second to populate, but pre versus post pandemic. So let's go back a couple of years, just so we can make a comparison. At this time, or at the end of 2019, there were about 52 million square feet of office space in the city of Austin, or the greater city of Austin. Right now, there are about 58 million square feet. So about 6 million square feet, or probably, about 10% more space in the market than there was then. The vacancy has nearly doubled. That's the tough news. If you own a building, that's maybe good news if you're a tenant in the market. However, absorption's been very interesting. We were rocking along at about 2 million square feet of absorption a year in 2019, and that had been going on for a while. With 1 million, 1.5, 2 million. It was 2 million was pretty sustained by 2019. Last year, we lost about 1 million square feet of absorption. And today, actually, we're at an inflection point this month where we've absorbed the underhang, if you will, the million that we lost, and we're right just about to zero on absorption right now. And because of some of the leases that we're seeing being signed right now, some of the large leases that we're seeing being signed, we're back to zero and then headed in a northerly direction as far as occupancy, which is the inverse of vacancy. So occupancy is headed up, and vacancy will be headed down soon. You'll start to see that in the fourth quarter this year and the first quarter next. It will start to see some positive absorption reflected in the marketplace and the numbers. Rental rates. Interestingly, a lot of folks say, well, certainly rental rates have come down during this time. Well, actually, 2 years ago, about $39 a square foot, that's all in. So base rent plus all expenses on average. That's not C space, that's not A space, that's just that average of everything lumped in together, not downtown or suburban, but everything. So $39 a square foot, and right now they're sitting almost at 42. So a $3 increase during COVID. So it sounds a little counterintuitive. We can go into that more if you like. The pipeline has dropped. Developers have looked and they pulled back a little bit. There are new things coming on to the market, but the pipeline had been growing through 4 and 5 and 6 million square feet a year. The pipeline now is down under 5 million, although we do still continue to see growth in the development pipeline, but it's not to the levels that it was. Vaccination levels. So kind of some storm clouds that we see. Vaccination levels, had been a little, how should I say, a little less than maybe had been expected months ago. But it seems like those levels are rising fairly rapidly now. Some of that may have been due to the Delta variant and some other things, but the vaccination levels are quite high in Austin. They're not everywhere in the world. In some places, they're very, very low. And this is a worldwide situation we're going to have to continue to pay attention to. Work from home, that has been something that a lot of people have kind of taken 3 steps back to look at how they work and what happens, how they want to self-actualize, what they want to do for work, and is this even the right, not only is this the right place in the company, but is this the right actual business for me? Could I be doing something different? And a lot of people have made a lot of changes during this time. The development pipeline, as I said, is off by about a third, and that's probably a good thing. Although what will happen is it'll whipsaw likely back as we come out of this, and then we'll have a problem on the other side of not having enough space. Shadow space or sublease space, we're actually seeing that decline quite a bit this year. Last year, obviously, some large companies put a lot of their space on the market to see what would happen if people would lease it, and there wasn't a lot of activity. Some of those were subleased, but many of them actually have reclaimed those, and we're seeing the large tech companies now are actually expanding. They're expanding from what they were, where a lot of companies have been a little hesitant because nobody really knows what this work from home and how many people are coming back, and mainly how they're going to want to interact and how they're going to want to operate. Is it individual offices? Is it hoteling? Is it somewhere in between? But there's some bright things. The Fed chairman has been very supportive of the economy and said he'll throw, as soon as the medical thing gets taken care of, he will throw everything he has at the economy to push it forward and to do everything the government can, which is actually quite a bit. There's some things he can't do, but there's some things he could really influence with. So that's good. You've got the support of the Fed. As we talked about before, the virus and the economy are interrelated, and that hasn't happened in 100 years. That a disease has taken out the world economy, but it has. And as soon as the virus is gone or has abated, or people are comfortable getting back together, it's off to the races. Stocks have been amazingly resilient. They were off a little bit in the beginning, actually off quite a bit, but down in the low to mid 20,000s as far as the Dow Jones, and now sitting around 34,000. So up quite a bit from the middle of the pandemic. We're probably over time going to see a lot more people per square foot in offices. We're going to need a lot more square feet, somewhat more square feet per person in the office. So as we get back to the office, probably folks are not going to want to be as close to each other for obvious reasons. So while there may not be quite as many people coming back to the office, the folks that come back are going to want to have more insulation between themselves and other people. There's going to want to be more square footage there. Most people do want to get back to the office, and that's for some obvious reasons. And we'll speak about that in a few minutes a little bit more deeply. All right, so we talked about the vaccination levels. The development pipeline has been reduced. Activity is stabilizing. We are in an inflection point in this particular month that we happen to be in. Work from home, really kind of a bigger bark than bite, and there's some dynamics going on. And like I said, a lot of companies are now going ahead, moving forward with their plans for additional office space in the future. And occupancy, really, that's a zero. That should be, over the next year or two, or certainly 3, should be a zero-sum game. So there are a few people that are, maybe on what we're seeing is 10 to 15% level that just aren't coming back. They didn't want to be in the office in any way, and now this is their excuse not to come back. But we're going to need more space per person for a while. The other dynamic that's not on here, but I think it's important, is that people are, I'll keep on going. Hang on. All right, you may or may not be able to see this, but this was something that we did to look at last year, to look at portfolio strategy decisions. And you know what? It's kind of small. I'm going to move on from this. And where people want to work. I'm just going to jump through those because they're really small.
We can see them well. I mean, it's up to you, Gaines, but we can see them.
I'm going to keep on. Thank you. So let's look at office versus away, or work from home, work from somewhere besides the office. What are the benefits of working in the office? In the office, you have collaboration. You have other people that work with your company that you work on a team with, or you work in teams that relate to each other. There's collaboration. There's culture. I think Angelo Sangelo is credited with saying, I don't know of anybody that's ever been given a raise over Zoom. So, the productivity is, typically you get a lot more done person to person, mano a mano, in front of somebody than you can on a Zoom call. And that's not to say the Zoom calls aren't important. There's been a tremendous amount. I mean, we would have been even deeper in the hole if it hadn't been for Zoom and things like it, and what we're doing here today. But that is not the optimal situation when it comes to collaborating and building culture and really instant productivity. Working from away or working from home, there's flexibility. The thing about, we don't know what you're wearing from the waist down, and it doesn't matter when you're at home, but you have flexibility. You can roll out of bed and be on a call almost immediately. There's no commute. You don't have time for that. You don't have to, plug in time for that in your day. And there's the freedom, and it's kind of attractive. It's kind of attractive. So, but difficult to have that collaboration, culture, and productivity when you're not face to face. I'm going to see if this works or not. And if you can hear it, great. And if you can, I'll tell you about it. I don't know that that's going to work. It's a little clip and it's very short. Somebody asked this fella, he says, so it's COVID and you're going to be at home with your wife and child. Do you A, shelter in place with them, or B, he says. So it's great to be with your family and everything. It's great, but there's a number of things working from home that are difficult. We all love our families. We all love our spouses and our kids and our grandkids and all. But having work in the home place, sometimes there are some conflicts. All right. There's some very large things, and Mark mentioned this. Samsung is in the process of making a decision, and there've been some offers from this part of the country, and BAE and a number of other large companies are building things here. The largest of those is, of course, Tesla, and it's not just Tesla and its factory that are important. And I say this even though this is an industrial thing, but it affects office because it puts more people into the marketplace. In July, there were, just as an example, there were 2 Tesla suppliers. One of them 500,000 square feet, one of them 100,000 square feet, that signed leases in Kyle in Plum Creek. Wow. That's a fair distance away. So, I mean, that's just an example because they couldn't find anything closer, right? So, very, very interesting dynamic. And that's just one example. So the actual facility, about 5 million square feet there when it's done, the acreage, 2,100 is now, they bought some more. It's over 2,500 acres right there. And that's a lot more than we normally have in our own backyards. The initial value of the building, over $1 billion. The jobs that they initially announced in July last year were about 5,000. And if you take 5,000 over the average of the income for each of the employees, it's close to 5 billion over the next 10 years. So they just said, Elon just said that he expects there'll be 10,000 people working there, so double by the end of next year. And they're still supposed to roll the first car off of the line there. I think they're doing Ys and 3s and the Cybertruck. I don't know which one will come. I'm guessing the Y, but I don't know that. But so jobs, 10,000 jobs and $10 billion over the next 10 years as far as the generation of income through the employees. And what happens, the employee that works at the Tesla plant, they're going to need a place to live. So they're going to buy a home or they're going to rent an apartment. They're going to probably drive a car or they have some kind of transportation. They're going to pay for insurance. They're going to, all the things they're going to buy groceries. So all that's going to happen here in Central Texas. And some people ask me, well, was it a good thing to give, any kind of a tax break or anything? Today, the taxable value of that, or let's say 2 years ago, before all this happened, the taxable value of that land, that 2,000 plus acres, was about $10 million. When they finish building a plant and it's up in operation, it'll be about 30 times that much. So while some people are not exactly crazy about incentives, I will say that a 30x multiplier works all day. So if you give a partial tax benefit over 10 years, you actually recover that in the 11th year and you're money ahead in the 12th year. And from then on, every year, you're way, way, way ahead. You just got to wait a little while, a little delayed gratification there. All right. I'm going to turn it back to Patricia or Molly, and they're going to introduce Roland, and there may be some questions later on, but I'll bug out for now.
Thanks, gang. Boy, this is so informative of what you all are sharing about what's going on in our economy and in the market for commercial buildings. I hope that our audience puts some questions in the Q&A and put them in now for Gaines or for Mark. If you have them, and we'll get to them at the end. Next, I would like to introduce Roland Gallon. He's founder and broker of Skout Real Estate. He's a real estate broker, investor, developer, and entrepreneur. As founder of Skout Real Estate, he focuses on architecture-driven properties, urban development projects, emerging neighborhoods and districts, and creative ventures. He has brokered, partnered, and collaborated on properties and projects valued over $400 million. Early in his career, Roland led business development and strategic planning at Nugistics, a startup he helped launch at AV Labs, which is a fund and incubator affiliated with Austin Ventures. Roland started his career as a business development manager at P&G and later as an investment banker analyst at Standard Chartered Capital Markets, New York. He received his MBA from the University of Texas at Austin McCombs School of Business and is a lead AP. He serves on the advisory council of the McCombs Real Estate Center and the Founders Circle and Dell Medical Society at Dell Medical School. So Roland, what can you tell us about residential and other urban development trends in Austin?
Thanks so much for that introduction. Great to be here. Thanks everybody for being on the webinar. I come from a kind of a atypical background in that I do residential and commercial, and because of that, I started doing a lot of mixed use projects back in the day, about 18 years ago, when it was kind of a new thing in Austin, relatively new thing in Austin, but one of the oldest types of developments going on in the world throughout history. Anyways, what I'm going to do is I'm going to talk about residential, mixed use, and adaptive reuse. I'm a very visual guy, so I thought I'd present some case studies and walk you through some projects I've been involved with and talk about trends in the industry. Again, residential, mixed use, and adaptive reuse. Some of the learning objectives I hope you take away from today are to understand some residential trends and some alternative construction methodologies and ways of building within the urban fabric, and also talk about some sustainable development and building trends as well. And before I do that, I just wanted to kind of give a snapshot of some key stats. I love Mark Sprague. I've been listening to Mark for, gosh, I don't know, over a decade, and he's the stat master. But here's some quick residential market stats just before I kick it off that I think helps, because the topic, the party topic of the day is always, it tends to always be the residential market, and everybody's talking about how is it a bubble, is it overpriced, et cetera. Where are we going with the residential market? So one of the helpful stats I found is what is the percent of residential listings that are over list price. So in 2021, this year, in June, it was 51% of listings selling over list price. In July, it was 47%. August is about 46%. And today we're probably hovering closer to 40% plus or minus. So you can see the trend coming down a little bit. That's still a very strong seller's market, obviously. To put it in comparison, August of 2020, it was about 27% of listings were selling for over list price. So we're gravitating towards the mean or median, as they say. And gosh, if you ask 20 brokers or real estate folks, I'm sure they'll give you different opinions on that. But I think we're going to be a seller's market for a long time. I think it might get closer to being a normal, next year, if I had my crystal ball. But I think we're going to have an inventory challenges moving forward for a while. Also, another big trend on the residential market is cash purchases are about, again, rough number, about a third of all buyers, and that's for single family and condominiums. And that's 2021. Kind of a third trend we're seeing there's bidding wars, not just for sale, but also for rentals. We've had about a 10 to 30% increase in rental rates year over year, plus or minus. Another trend is investors are still out there in big ways, but some of them are kind of taking a pause because of pricing being where they are. And if you survey investors, about half would probably say they're waiting and for the right opportunity. Another trend is condo interest has gone up dramatically. It was kind of a lagging trend versus single family residential. For obvious reasons with COVID, and people thought that nobody would ever live in a condo again a year and a half ago, but we know that's not the case. So condo interest, I'll show you some of the condo projects in the case studies that have been pretty resilient and have been pretty successful over, before COVID, during COVID, and after COVID. And then last but not least, there's kind of a myth out there in this market that you can price the property sky high and get whatever you want for it. And that's just not the case. I think that's only the case for the creme de la creme properties. Obviously, if you have a fully leased, downtown property, a trophy property that is just irreplaceable, that's the case. But in most cases, the fundamentals still matter. So let me move forward with my slides here. A nice view of a downtown skyline from a few years ago. So on the residential mixed use case studies, the first project I wanted to highlight is Magnolia and MLK. This is the first modularly built mixed use project of its type in Austin. Project I was involved with, it's about 24,000 square feet. This is an interesting case study in that the developer could have gone much larger. It's a half-acre site, but they wanted to be sensitive to the scale of the neighborhood and not overbuild and not have to do underground parking, et cetera. So a very interesting project. The modular construction it's a similar technology as stick built. The only difference is it's built in a factory. It's monitored and inspected throughout the entire process in a conditioned format, factory format. They deliver I'll scroll through some of these shots here. They deliver, because of time, I don't have a video, but they deliver the modules for the residential in boxes that have cabinets, countertops, plumbing and lighting fixtures already in place, sheetrock, etc. They were delivered on site, about 70% complete. There's some nice shot here. These are 17 residential condos ranging from 1 bedrooms to 3 bedrooms. And then we have a corner retail space that houses 3 ground floor grab-and-go eatery spaces. There's a view of the courtyard. The benefits of modular construction are that it cuts down the construction time to about half the time. It's a quicker time to market. It also limits on-site construction time, so less exposure to the elements, and in theory and practice should have a more durable construction if you do the modular construction right. This project has 2 courtyards, parking under the podium, has, again, as I mentioned, small walk-up eatery spaces. We go back, ground floor eatery spaces as part of the project. This was a proof of concept project for the developer, which was also the architect, and there's others in the drawing board. To put this, to summarize this project, 21,000 square feet of construction was put in place just in 5 days. Architects have been working, on prefab and modular concepts for literally hundreds of years. Some have been successful, others have not. There's a great deal of fixed costs up front to build a modular factory. But in the end, I think there will be some success. This is one success story in a small way. And I personally think a lot of the innovative projects are kind of small, medium scale. Big projects tend to get all the headlines, whether it's a big high rise or Tesla, which are obviously important for obvious reasons. But I believe some of the cooler, more innovative, entrepreneurial designs and efforts are on a much smaller, middle-sized scale in the urban fabric. And this modular can work well in urban contexts that have tight sites where logistics are difficult. And I think this delivery type of system is promising moving forward. So moving on to another case study. Let me keep going. The next project is Santa Rosa. It's another urban infill mixed-use project. Another project we were involved in. This was on a small site, less than an acre. This was a mixed-use condo project where we really emphasized the handmade. We work with clay imports tile on some of the tile for the interior and exterior. It's a nice feature that's typically reserved for single-family residential, and we really wanted to have a nice design feel for this project. The developer made a conscious decision to keep the building only 3 stories to be sensitive to the neighborhood. There's single-family residential behind the project. There's industrial in front of us. Light rail, metro rail is nearby as well. So this is a good example of a transitional site that is ideal for mixed use. The nature of this project was to be conscious about connections with the outdoor. There are terraces, breezeways, and balconies throughout the project. Again, this was designed pre-COVID, but during COVID, we actually sold out of this project right in the middle of COVID. And I think it's because of all the connections to the outdoors for a typical condo project. We also have a diverse, here's some interior shots, clay import shots. We have a breezeway. Here's a shot of the breezeway. But we also, I think what made this project successful is a diverse mix of units. We had studios, 1 bedrooms with studies, and 2 bedrooms. The 1 bedrooms with studies sold out very, very quickly in the end because of the home office, work from home movement, which I think is here to stay. I was predicting that was going to happen anyways before COVID, and here we are. Also, this project allows for, this is the back shot of the project with some studios in the back. This project allows also for small business ownership of condos, of real estate. We have 6 retail condos in the front that were sold as shell spaces, and we have a bike shop that was able to buy their space and own it, a t-shirt shop, nail salon, an attorney, and an architect office. So it's great to lease spaces, but it's even better to have a little bit of ownership in your own property, in your own space. Next project is a next door creative project. I call this project kind of a work of art. One of my personal favorites on the east side. Obviously, the previous projects were all in East Austin. This is a little shout out. This is a 4-star designation from Austin Energy Green Building Program. This was conceived because there's, as you know, there's a lack of industrial building stock in Austin. I grew up in the Midwest, and I'm here in Charleston, South Carolina right now, where there's just an amazing industrial base of amazing older stock that can be adaptively reused. This project is new construction, to be clear, but the vision of it was the architects, Pollen Architecture, they're the developer, landlord, and the architect. They moved on the east side in 2003. Before this, they redeveloped an old building that used to house a guitar store and converted to their architect studio office. And then they bought the adjacent lot and built this project about 3-4 years ago, if my memory is correct. 27,000 square feet of creative office and studio space. The spaces range from very, very small spaces, 200 square feet to 3,000 square feet. We have bike storage. We have lockers on site. We have a bus stop in front. Very multimodal in connectivity. You'll see these concrete panels throughout the exterior. Each one of those 13-foot concrete panels were precast and formed on site by Pollen and reused as cladding in the building. Great natural lighting, protected heritage oak tree in this shot. We have outdoor courtyards. We have Texas native landscaping, deep overhangs throughout. There's a system of, there's Pollen's office there. Great industrial spaces that were leased as is, and some people decided to also add conference rooms, etc. System of rain gardens throughout, which retains water. Here's a good shot of that. Retains water before percolating through into the ground. We have electric charging stations, operable windows, open air walkways, as you can see here. There's a communal terrace with downtown views, and we're home to several design firms. Not only Pollen Architecture, we have Lake Flato, we have some of the top architect design firms, and also some tech software companies in the project. So I could talk about this one all day long, but I'll move on. There's an aerial shot of the project, again on East 12th Street, just a few blocks from downtown, a few blocks from Del Med, and 1 block away from the UT baseball fields. So the next project I'll move on is the Chicone mixed-use project, also on the east side. This was interesting project that was financed in part by the Texas State Housing Corporation and using the Texas Housing Impact Fund. Chestnut Neighborhood Revitalization Corporation, CNRC was a developer, 28 units total with ground floor retail space. These are all for sale. The city of Austin provided equity through an affordable housing general obligation bonds, 21 residential units, and those are up for people making up to 80% area median family income. This also sits on a city designated land trust that keeps it affordable and remains affordable even on the resale. And then the commercial spaces. Here's a view of some of the common spaces. The commercial spaces were also sold to small business owners, and we, myself included with the CNRC board, we interviewed each and every prospective buyer to make sure we were doing our best to provide services in retail that can benefit the local neighborhood and the community. So we have a pet store, coffee shop, we have a Pilates studio, some offices, architect studios, and a bakery. So I think we did a pretty good job there. So this is a great example of public-private partnership and, building a project, again, to scale that's not too out of place in central Austin neighborhoods. I'm going to move on and quickly go through these. This section talks more about sustainable development, adaptive reuse and revitalization, which is one of my passions and interests and specialties. This first site is more of a revitalization type case study. This was Christchurch relocated their church from another part of town to East Austin. This was a previous church for a congregation that was dwindling in membership, and they wanted to find another church. So Christchurch remodeled and redeveloped the site into a beautiful project. And they really wanted to be in an urban neighborhood with walkability and connect with the neighborhoods and not be a standalone church all by itself. So this is totally interconnected with the neighborhood. It's right by Cenote Coffee Shop. Moving on, one of my favorite projects, this is, in full disclosure, this is the property that I was a partner on. This is an old airplane hangar building from the 1920s. This is in the Crestview, North Lamar Airport, transit-oriented development zoning area. This used to be an airplane hangar building in the 1920s. World War II ended, and they decommissioned that. This is the first airport in Austin. They decommissioned that airport. Now it's neighborhoods, and obviously they moved it to Miller. But this was one of the original Browning hangars. There's a Browning hangar at Miller right now. This is one of them. This was relocated across the street here, and it was home to Reinhardt Manufacturing for several decades, 50 plus years. This is a shot of when we purchased it, the interior. They had these beautiful drill presses that were used. This one was used in aircraft carrier in World War II, by the way, and we retained one of those in the redevelopment. It just shows you before and after they cleaned it out. We were trying to partner and find a great business for the property. And we got Garden 17, a garden center and nursery, to call this place home. They raised the roof, exposed the original airplane hangar trusses, which was outstanding. Added some garage doors, all open air space. It's much fuller now. These are older shots, but brought in some plants and some beautiful garden accessories all throughout the project. And their vision was shared with our vision, and that was to share the authenticity and the original structure. We had multifamily developers and other developers that wanted to tear down the building, believe it or not. We said, absolutely no way, you're crazy. And we stuck with our guns, and I think we did a good job. Another exterior shots of the building. And then I'll go through the last ones quickly. The next building is East 6th Street building. I helped sell this building a few years ago. It's right on the Waller Creek in downtown on East 6th Street. This was built in the mid 1800s. The seller was ex-mayor of Austin. About 10,000 square feet of usable square feet. It's a historic landmark, 1994. It's the only freestanding building on East 6th Street. It's right at the nexus of the Waller Creek, all that redevelopment going on. Native limestone, reclaimed Texas hardwoods. Let me show some exterior shots. This was how it looked like when we sold the building. A little functionally obsolete, but beautiful longleaf pine upstairs and downstairs, right on the Waller Creek. And this is now being, just because of time, I couldn't include all the slides, but this is being redeveloped into new office space for a Spectre Air. They're adding a rooftop terrace and doing some amazing things inside the project with Chicone architects. And then last but not least, we have, this is where my office is. This is 904 West. This is the first downtown mixed-use condo project with solar. This was an old apartment building, multifamily building that was redeveloped into office. So we have photovoltaic on the roof. Each condo unit, residential and commercial, owns their own solar array. It's owned and deeded with the condo unit, And we have several owners that have 0 or single-digit electricity bills, so it's pretty awesome. A little interior courtyard, recycled tire rubber for the surfaces, all LED lighting, very walkable. Here's a nice aerial shot of the building showing the pool and the superstructure. Everything was redeveloped, was taken down to the superstructure, and then redeveloped, brought in new mechanical, electrical, plumbing, and of course the solar. You can see amazing location, right in downtown, but kind of away from downtown. Walkable, great neighborhood. So I think that's it. I'm going to stop there and head it over. Thank you.
Oh, Roland, this was fantastic. What a beautiful, beautiful things that you are doing for our city. Just, I love it. Adaptive reuse, taking things that, you're in Austin and revitalizing it. I think everybody that's lived here, we want Austin to continue to look like Austin and not become Houston, for example. Houston's great, skyline is gorgeous, but we want to retain Austin, and I just love that that you are doing that with adaptive reuse of those properties. Just absolutely gorgeous. I hope that our audience, this stimulates some questions from our audience that we can address soon. But yeah, when you were talking about in the beginning of the residential, the percent over the price, don't know if there's not a neighborhood in Austin that hadn't felt that. The asking price, and probably tempting for some to go ahead and put their houses on the market, but where do you go?
Well, sometimes I tell people it's nice to have multiple offers, and it's great to share that with your friends over a cocktail party or something like that, but it just takes one good buyer. So whether you have 3 offers or 15 offers, I mean, we all know the residential market. We've been, that's been in the media a while, how strong that's been. But part of me, not to digress, but part of me always says, hey, tell sellers, it's nice to have 3 to 5 buyers, and 15 buyers. You disappoint 14 of them. So, anyways.
Yeah. Well, I just there's just a lot going on here. I mean, it's almost mind blowing, but I'm glad that there are you that are in the industry that are keeping your finger on the pulse of it and figuring out how to make it still work and thrive for the residents of our community. So yes, I hope that we get some, welcome the audience to ask questions after our next presenter. So I'll go ahead and introduce our next presenter, our final presenter, which is Christine Freundl. She's a redevelopment project manager with the City of Austin's Economic Development Department. She has over 15 years of experience in land planning, architecture, economic development, and urban design, working in both public and private sectors on projects such as K-12 and higher education facilities, downtown and campus master planning, form-based code formation and implementation, and the creation and management of the City of Austin specific regulating districts, including the transit-oriented developments and East Riverside Corridor, excuse me. Currently, Christine is part of the team overseeing the redevelopment of the 720-acre former Austin Municipal Airport, known as Miller, through a public-private partnership, as well as implementation of the Colony Park Sustainable Community Master Plan, and is leading the redevelopment of the 19-acre St. John site, commonly known as the former Home Depot, located in Northwest Austin. Christine is trained as an architect and holds certifications with the American Institute of Certified Planners, the USGBC, U.S. Green Building Council, and Congress for New Urbanism and National Development Council. Christine, can you tell us about the City of Austin's public-private partnership program and how these projects come to fruition and help shape our community?
Well, thank you. I'm happy to be here today to talk a little bit about how the Economic Development Department approaches public-private partnerships. And bear with me, the first part of the presentation is a little instructional, but I think it's important to give a little background on P3s, which can be a bit of a nebulous term depending on their context. But once I get through those slides, we'll get into some numbers on our active projects. So getting into the P3 overview, there are a few definitions of public-private partnerships, but I particularly like this one. Overall, the big picture, a public-private partnership is a way for a government and an agency to partner with the private sector to deliver a service or an asset for use by the general public. Some examples of P3s that P3s are used to deliver are horizontal infrastructure like water or wastewater. This includes subsurface improvements or can be vertical when addressing the need for something like a new water treatment facility. It can also include transportation infrastructure, so for building a new train station or implementing improvements in a station area adjacent to transit. It can also include public roads or streets and also bridges. It can also include service buildings like libraries, schools, or community centers, as well as emergency or public safety facilities like fire stations, police stations, and hospitals. And, you know, these are some common examples of P3s, but there are many, many others, especially as this particular tool gets expanded around the United States. Traditionally, the goal of P3s has been to use a private delivery method, but to retain the public asset under public ownership long term. And this comes with the caveat that the business case for P3 needs to support a private delivery method. And that's because P3s, they're an informed and intentional break from traditional procurement methods and should be used when P3 can be shown to allow for faster and more effective project delivery. And I'm going to touch base a little bit later in the slides on one of the ways that you can make the business case for a P3. Generally speaking, public-private partnerships are an attractive tool because they provide the possibility of reducing costs, improving quality control, and expediting the delivery of services. So what are the pain points that P3s address in order to deliver on these goals? One of those is unclear responsibilities. And this means to say that a lack of clarity about decision-making and project governance can hinder effective project delivery. In P3s, they require the owner or the governmental entity to negotiate and contractually lay out the goals of the project through performance standards, risk allocation mechanisms, responsibilities, rewards, and penalties in a transparent and realistically viable manner. By realistic, I mean AKA commercially viable manner. One of the other pain points is poor alignment. In a large government agency, such as a municipality, projects can be identified for their importance and merit, but they may get lost in a pool of equally important projects. When a project is not backed by a strategic and robust commitment, implementation can be delayed. So to meet the threshold for departing from traditional procurement methods, P3s are highly vetted and screened from a portfolio of potential investments and have a high degree of public visibility that allows the project commitments to be aligned with a strategic outcome. In Austin, the adopted Austin Strategic Direction 2023, which is inspired by our Imagine Austin Comprehensive Plan, provides such guidance. And it allows P3s in Austin to be vetted and prioritized through an overarching strategy that delivers on improving quality of life. There's also a lack of forward-thinking approach. And I know this may be shocking to some in the virtual room today, but governmental agencies are not always at the forefront of innovation. And this is because they are often constrained by existing standards, regulations, methodologies, and limited exposure to best practice. And P3s, as a premise, encourage innovative problem solving throughout all the phases of the delivery of the project. There's also a lack of project ownership mindset. So project delivery done through traditional procurement methods, such as low bid, can create a disconnect between the contractor and the owner. P3s address this by having the private partner adopt the perspective of the owner, AKA the governmental entity, because performance incentives for the project are tied to a return on investment, or ROI. So at their core, the performance measures laid out contractually encourage the private partner through financial incentive. There can also be a lack of streamlined execution. Large projects have a lot of moving parts and can suffer from competing objectives, time frames, and resource commitment. This is very true for large multi-phased or multi-use projects. In P3s, the design, procurements, and supply chain are defined and aligned through contractual obligations that are set forth at the beginning of the project. And so this is not to say that flexibility is not also built into the process. Instead, flexibility is also defined contractually, providing more predictability to decision-making throughout the process. And lastly, there can be a lack of aligned resources. So owners or the governmental agency can suffer from inadequate internal resources to ensure progress and daily decision-making is made in a timely manner. And I'm sure as many of the folks in the virtual room know, staff, whether you're in the city or the county or a transit agency, can get pulled in many different directions. P3s move the responsibility of project delivery over to highly capable and well-sourced private sector teams who operate through performance standards that were contractually negotiated at the beginning of the project. Again, aligning performance with a return on investment incentive. So the next question is, what in the structure of a P3 allows it to address the pain points we just discussed? So the biggest factor is that P3s allocate the appropriate contractual and/or financial risk and responsibility to either the public or private partner. And that's based on their area of expertise or attributes. So for example, for the public sector, they may address necessary changes to laws or ordinances such as zoning. The public sector also has the unique ability to hold land tax-free and transfer it to the private sector over the life of the project. So this can allow the partnership to maximize market conditions over the long-term phasing of project delivery. Additionally, the public sector will frequently address off-site utility upgrades as they can be shown to catalyze the project while also serving a regional benefit. And lastly, the public sector has the ability to issue debt as appropriate at lower interest rates and at longer terms. And this allows for later phased reimbursement to the private partner's upfront capital investment. So as I mentioned, the private sector typically has the benefit of upfront capital, and that can be invested at the beginning of the project to address items such as pre-development costs and on-site infrastructure installation. The private partner is also typically better suited to competitively market the project to vertical developers and potential leaseholders. And the private sector is typically better equipped to deliver high quality design and construction for the project. So all of this is not to say that public-private partnerships are a panacea for the ills of governmental procurement. In fact, P3s must be carefully evaluated to determine whether they can deliver a greater net economic benefit to the community, taking into consideration the whole life costs of the project when compared to a traditional procurement method. In addition, the advantages of the P3 need to outweigh potential procurement and/or revenue risks for the project and the partners. Probably one of the most important points to consider and to remember is that private capital invested in a P3 project comes with the expectation of a reasonable return on investment. So in other words, in exchange for assuming the risk in the form of upfront capital, the private sector receives a return on their investment. Therefore, the financial risk must also make sense for the private sector partner as well as the public sector partner. So one tool for assessing the benefits of a P3 over traditional procurement is a value for money assessment. And this is used very early in the stages of project screening. And it's based on international best practices and typically involves a combination of qualitative and quantitative approaches that ask questions such as, is this type of project likely to be suitable for public financing? Has this P3 been structured well to withstand a competitive solicitation or bid process? What would this project look like structured under a P3? What would it look like structured under a traditional procurement? And in particular, looking at any risk-adjusted costs for both of these scenarios. So when all of these critical pieces that we discussed so far align, then a P3 makes sense. You know, we need to have a public asset or a public need. It needs to align with the strategic direction. It needs to provide greater economic benefit to the community. At its core, it needs to promote a more efficient project delivery. And the public sector participation needs to outweigh its risk. And as I mentioned before, the private sector participation does need to yield a return on investment. So if we look at what the city is doing in repositioning underutilized properties through P3. So as I mentioned earlier, when we were discussing the process pain points that P3s can address, one of the benefits to project strategy alignment is that P3s are thoroughly screened and vetted from a portfolio of potential investments. So those community benefits align with many of the growing pains that the previous panelists have discussed up to this point, including affordable housing. The redevelopment division, which is housed in the economic development department, and that includes myself and a team of multidisciplined professionals with backgrounds in engineering, architecture, landscape architecture, real estate planning, and finance. And as a team, we're tasked with assessing and repositioning underutilized city-owned land as identified by Austin City Council with the goal of maximizing community identified benefits. So using a portfolio approach allows the assigned assets to be viewed through a strategic lens across the entire grouping of properties. And these assessments are based on the property's specific market and community context. And this allows for a holistic approach to identifying and highlighting the unique geographic attributes, system connections, and physical site characteristics for each parcel that contribute to making a successful project. And now we get to the good part. We'll go through some numbers and some projects. So these are only a sampling of some of the projects that are underway in the redevelopment division. So this map illustrates a sample, and these projects include legacy projects that commenced decades ago and really kicked off the redevelopment division's role within the city. And these include the Seahome District located down here, as well as the Green Water Treatment Plant. Others of our projects are ongoing commitments, and this includes management of the 2nd Street District here, along with its lease obligations, ground floor lease obligations, as well as the Austin Film Society 20-acre campus here, to which the city leases 20 acres to Austin Film Society. And it also includes recent projects that have completed their RFP, request for proposal, advertisement, and have a preferred developer selected and are moving forward with exclusive negotiations. And this is 6909 Ryan Road, which is at the crossroads up here of Airport and Lamar, also known as Crestview Station, adjacent to Crestview Station, and then also the St. John's site, which is commonly known as the former Home Depot tract. So I'm going to talk a little bit about Sea Home. I think a lot of people are familiar with it, but I think it's a really important project to talk about from a legacy project that's very close to sunsetting. So the Sea Home District was 85 acres of city-owned industrial land located in downtown Austin, adjacent to Lady Bird Lake in the Union Pacific Rail Line. The power plant was completed in the 1950s and encompassed both the power plant and a pull yard that served as materials storage for the rail line. In 2001, the Sea Home Master Plan was completed, and the vision to transform the underutilized land into sustainable mixed-use development that would come to encompass the adaptive reuse of the power plant, redevelopment of the green water treatment site, and a new central public library was underway. As a public partner in this public-private partnership, the city invested in public infrastructure that included both subsurface water, wastewater, and stormwater improvements, as well as the installation of complete streets that contributed to reinstating and extending the downtown street grid into the district. To achieve this, the city incorporated agreements for both the sale and lease of portions of the 85 acres. Overall, this public-private partnership delivered 2,300 residential units, roughly 200,000 square feet of retail, roughly 1 million square feet of office, several art and public places installations, a new central library, a high-quality pedestrian vehicular bridge that provides a continuous spine along the downtown from the central library all the way to the convention center. And probably most important in our current climate, it contributed $2.7 million in funding to the Affordable Housing Trust Fund. So the initial investment of roughly $220 million on behalf of the city has yielded roughly $1 billion of private investment in the district, with estimated tax revenue over $5 million per year. Next, I'm going to talk about an ongoing project that we're working on, and that is the Miller redevelopment. And it's on the site of the 711-acre former Robert Mueller Municipal Airport, which closed in May of 1999. And I think it's good to talk a little bit about the story of Miller. Going back all the way to the late 1980s, there was clear support from the surrounding communities to transform this site into something that could be a better neighbor for the surrounding neighborhoods. In 2000, a community vision was adopted through the Miller Master Plan with a 20-year expected build-out. The Miller Master Development Agreement, which serves as that contractual basis that we discussed before for the public-private partnership, and the planned unit development zoning district were adopted by City Council in 2004, and the project broke ground in 2007. To date, the project has delivered roughly 5,000 of the projected 6,900 market rate residential units, roughly 1,400 of the 1,725 income restricted affordable units, 121 acres of the required 140 acres of publicly accessible open space, and 3.1 million square feet of projected 5.5 million square feet of commercial space. Additionally, Austin Independent School District recently broke ground on an 800 student Northeast Middle School, which is anticipated to be complete in fall of 2023. This school marks a major milestone for Miller as a complete community and represents yet another example of P3, which can be a public-public partnership. Not touching on that today. And lastly, the last project is a early in the process project, and that's the former Home Depot tract, which is 13.8 acres. It also includes the tract north of it, which was a former Chrysler dealership, and that is 5.2 acres. So total, the site is 19 acres, and it comprises almost a full city block from St. John's Avenue all the way up to Blackson Avenue. The surrounding St. John neighborhood has a rich history dating back to the 1890s when it was established as a freedmen community for African Americans. For the century following, the St. John site served as a central anchor to the St. John community, first as the location for the St. John Industrial Institute and Orphanage, and then to the St. John Elementary School until the 1990s when it was sold and developed into the Home Depot and subsequently acquired by the city for new public safety facilities as part of the 2006 bond. In 2017, the Austin City Council passed a resolution directing staff to work with the St. John neighborhood to envision how the site could better serve the surrounding community. And in 2019, the University of Texas Center for Sustainable Design joined the effort to support the community in identifying community goals, while also test fitting how some of those goals could be accommodated on the site. In July of 2020, City Council passed a resolution directing staff to move forward with a solicitation to seek a development partner that could realize this vision that had been set forth by the 2-year prior community engagement process. And in September 2020, staff issued a request for proposal for a development partner. And in July of 2020, council approved city staff to enter into negotiations with Greystar and the Housing Authority of Austin, and those negotiations are currently underway. So this is cryptic, looking back to inform looking forward. What does that mean? Well, let's see. So one of the things that the pandemic has pointed out is the inequities in our community, specifically with marginalized and communities of color. Already existing inequities related to housing and access to healthcare has come forefront in the pandemic and has definitely been exacerbated. So as we move forward with this portfolio of properties to reposition, we have recognized the need to look back at already completed projects to see if we can identify areas where the projects are underperforming, specifically under an equity lens. And to do that, we are working with a Fuse Fellow, shout out to Wani Torres, who is helping us develop a scope of work to assess the impact of past City of Austin redevelopment projects on local communities, specifically understanding what impact, if any, these developments had on residents of color and lower socioeconomic status. And a little background on the Fuse program, it pairs fellows with senior government leaders and community members to lead strategic projects that employ a strength-based approach, advance a racial equity lens, and address the most pressing challenges facing communities. These fellows develop each project by working closely with the government and community partners to create a fellowship based specifically on local needs. And the fellows bring with them a valuable equity lens, cross-sector expertise, community engagement experience, network building, very experienced talent. They are highly developed professionals themselves, and the ability to focus on a sustained impact for the project. And the progress of this effort is that we have completed that scope and we'll be putting that out for procurement very soon. And that completes my portion of the presentation.
Christine, thank you so much for that. I think it was very informative, and I just am encouraged by these public-private partnerships and the goal for them to be the best, for the community and for the private entity that's entering the partnership, a mutual best ending for both. And also at the size of these, they can be fairly smaller in scale to very, very large. So it's very interesting that the city is taking on this this challenge with working with private to make the community a better place. So thank you.
Sure. Yeah. And as land values continue to increase in Austin, one of the city's biggest assets that we have is land. And so it's really important moving forward to make sure that if the decision is, aligned with the strategic direction to put these properties back into use for the public, that there's a framework in place to make sure that they are serving the community. As well as I think that equity look back is going to be a really important piece of developing these public-private partnerships moving forward.
Well, Molly, I guess I'll turn it over to you.
Hold on just a minute. I was trying to bring up the
Oh.
side of the speakers. Can you guys see that?
There we go. That's great.
All right, I just wanted to see if I could get that up first.
Oh,
So, what's that?
it's kind of not.
That's all of our technical stuff here today. Okay, let me start up. I wanted to start with a question that from the audience that they asked, what is the city doing to be a leader in sustainable housing? And of course, I have to add a little nod to Austin Energy Green Building. We have been around for 30 years, and our program has rated over 18,000 single-family rated homes and almost 45,000 condo and apartment homes. We have there's a long understanding in the city and a commitment to green building because it's a necessary component of affordable housing. The city has passed a climate equity plan, and we're one of the first cities to adopt the 2021 IECC. And Christine, I thought maybe you could kind of expand on that as well.
Sure. And one of the things I did not touch on specifically is that, as part of these public-private partnerships, sustainability is typically a goal. And I know for the Miller project, we have minimum Austin Energy Green building and LEED requirements. So there's that green building perspective. And the last fun fact that I was given is that I believe it's the largest concentration of solar in the Southwest. And we did recently partner with Austin Energy Green Building through a Department of Energy $3 million grant to install one of the first battery storage facilities within that project.
Awesome, thank you. So Roland, we had a quick little clarification question. And then also I was just going to do a little follow-up question to that. What is the name of the modular company?
It's MA Modular.
Okay.
Chris, the architect, they have a modular sister company called MA Modular. And I can, if you feel, you can reach out to me and I can give you more specifics.
All right. And then Roland, are there supply chain issues in the modular construction world as well? Do you know?
There are. I mean, every construction industry has been hit by supply chain, raw material increases. I think the biggest with the Magnolia MLK project that I showcased, the biggest it wasn't even a supply chain issue, and this is not a direct answer, but the biggest holdup for that timeline was the fact that part of the project, the hard corner of that project, was built on site, where the ground floor grab-and-go eatery spaces were. Those are 3 small grab-and-go restaurant spaces with 2 residential lofts above it. That corner was built on site. So because of the approval process and many months of waiting to get CO for that commercial corner, that held up the entire project. Although all the residential units were virtually finished, ready to go, the timeline was expedited because of modular. We had to wait several months and lost valuable time because of the on-site approval process for the commercial hard corner. So it's not a direct answer, but a related overall timeline issue.
And I can kind of address that too. Obviously, anything to do with plumbing, iron, rebar, etc., is all delayed now, anywhere from 90 days to 180 days presently. And I think that'll continue to be an issue. So although Roland could have everything delivered, it still needs to be hooked up, and there's pieces that need to hook it up. And then the other issue is labor. In the last 10 years, we've lost about 8% of our labor. Just they've gone to other industries and such. We don't train industrial trades at our high schools like we used to. So that's another issue. But also, obviously, immigration's the biggest issue in preventing that labor. They build most of the Southwest primarily.
Yeah,
Another item to consider.
jumped in on that, Mark.
Do what?
I said, I'm glad you jumped in on that because I was going to ask you this follow-on question to that. So that's perfect.
Another item that that may be important to recognize is during all this time, the longest lead times on planning and zoning are right now. It happened. It happened during the Samsung when they were getting their approvals and getting their second plant built, and it's happening again right now. So that there are some long lead times on a lot of things: labor, materials, just city processes and things like that. And not to say anything bad about the city, because we love the city, but that's just a fact of life right now.
In the city, they had 41% more applications last year for building and development. And remember, people go, well, they should have staffed up. And I'm going, no, you had COVID and they're doing the opposite. They were reduction in force. So, it's always easy to navigate after you've had an issue in industries. It is not that easy as you're going forward. I do like Steve Sarkisian made a comment in all this time. He says the reason your windshield is so big so you can see where you're going, that's why your rear view window is so rear view mirror is so small, is because you need to forget about that. But at times, everybody wants to focus on what happened in the past. That, oh, we should have done this, we should have done that. And, having been a consultant, having been at the highest level of a lot of corporations, the greatest comment I ever heard from a CEO is, I just hope 51% of my decisions today are correct. And I kind of looked at him and smiled. He said, you have something to say? I said, I've never heard that, but that is honest to God truth, because there's no way we can make 100% correct decisions as we go into any economic trend. You rely on history, and sometimes history is not the greatest teacher, as you find out. So that's way more than you want to know. But again, it's always interesting where people go, well, it's the city's fault, or it's the supplier's fault, or we've not done this, or we've not done this. And I'm going, yeah, that's easy to say now. What are we going to do to prevent that from happening in the future? So,
yes. It is definitely the first time for all of us. And I know the city has also introduced an expedited review plan program. So that has helped with that process as well. Let's look at some of the other questions that we've got. Let's see. Roland, how have the demographics of home buyers changed since COVID? Have you seen any since the pandemic?
I think anecdotally speaking, I think you're seeing a higher percentage of owner-occupied buyers rather than investors for some of the reasons we mentioned earlier. I think some of the cash buyers are of course investors, but some of them are just people that have the capital and or saved up money and or have significantly larger down payments to win in multiple offers. But yeah, I think the demographics over the last 10 years have kind of stayed generally the same, although I am seeing more and more people obviously from out of town. There's also, I think, a mix of folks that may have also buying second or third homes. I've seen that, especially kind of in more rural markets where they may have an urban or central city place either in Austin or somewhere in Texas or outside, and they're buying a second property, vacation home. It might be a VRBO, it might be just a second home that they come. So I'm seeing some of that as well. And then also, seeing a lot of and this has been well documented and discussed, just a lot of people that are looking for more, space for work from home. That's obviously the case, more green space. And you know, and I'm also seeing uptick in people looking for live work scenarios. I've worked on a lot of live work projects over the years, and I'm seeing that as a continued hotspot. I think there's always there's always a undersupply of that type of product in the market, where people can truly live and work, not just have a second home office, but truly have a studio, retail space, office space right next to or part of their main residence.
And Molly, yeah, it's a great question, but from a numbers geek, it's always a delayed reporting. So if you're asking us specifically, what was the mix of people different from previous years? We don't know till like 5 years later, because it's either census, they now quit doing the post office, where we could see who's disconnected and what addresses changed and such. So it's always a guess. It's more anecdotal. I mean, Roland and I can sit here and same with Gaines and give you some projections, but my CEO says, "I'll show you about those numbers." Now, and my response always is, "Well, I'm 50% sure." And he goes, "That's your answer?" I said, "Yeah." I said, because I mean, who could have seen COVID? Who could have seen the snowstorm affecting us? So there's just so many. Last year was one of those years, and I said so many times I was wrong. I thought the car dealerships would go away. There's so many things that I thought would go away that didn't, because we didn't know what COVID's effect was. As Gaines said, we thought offices go away. And when I first started the process last March, April, talking to Wall Street, I kept getting the response from engineers who know where the growth is happening. So you need to talk to office architects. And so I started with office architects, and they're saying, we can't hire quick enough. So as Gaines alluded to, we knew at that time that we were going to have a greater demand for office, even though we had 3.5 million square feet come on the market because of COVID. People go, well, you're saying two things. I said, exactly. They didn't happen at the same time, but we knew that we would not have enough office space. And during all this, realize that financing in all arenas, mortgage to development, got tighter. Why? Because we knew at the initial, when I first met with Wall Street into March, the prediction was, hey, 1 out of 5 businesses will go away historically. In Austin, it's been about 40% of businesses. The good news is we've had more startups than that 40%. In Dallas-Fort Worth, it's 38%. So hospitality, leisure, and retail continue to be hit harshly. I would grade them all on the F level as far as investment. And people go, well, what does that mean? I said, they can't get lending unless it's very, very harsh guidelines, much higher rate, but they're working at 50% of their pro forma. So it is always a great question in the public, because they get so much, including myself, at the push of a button. We go, well, what were the actual numbers from last year? And that's where you'll see somebody like me or a state demographer go, well, we don't have numbers from last year. Well, when's the last year you had them from? Probably we just got the 2021 census, but the 2020 census, we're going through those numbers. So it's never timely information. The closest we have to that is some of the private reporting that we get from, say, Metro Study and Zonda and some of those sources, but there's nothing we can specifically point at and go, we had more males, more females, more Hispanics, more Asians. We can look back, like as I said, 5 years ago and tell you, but it really is hard to say specifically we had this many people.
Yeah, thank you. I have a little fun follow-up question for everyone and see what each of you think. Somebody asked, Austin gets compared to a lot of other cities these days. From a real estate perspective, what city is Austin most comparable to?
I'll take that to start with and let you all bat it around. With Army Futures Command, that's probably the biggest announcement we've had in the last 20 years. Bigger than Tesla, bigger than anything. because of their budget. They spend about $4.5 billion plus a year, funded 22 startups last year, and their budget is about $4.5 billion a year. I would have to say your comment leads right to the answer. We are competing against Boston, San Jose, San Francisco for the same talent. And we will continue to. Is there a smaller city? And people go, well, what about Nashville? I said, well, it's a union state, so you'll never see corporate headquarters there. They'll go, well, what about Orlando? And I go, well, Florida is going to be aggressive in the growth, but not as aggressive as Texas, not as aggressive as Austin. So I would say I don't know another metro that has the conservatism of the state as well as the liberalism of the city. And people always want to say, well, there's got to be something like it. And I've done market studies all over the United States, and I really have not come across the unique personality of Austin. We're the fifth highest educated city, as I said earlier, compared to the other metros. We're fairly forgiving, and I mean that sincerely. Okay, I'd like to have a discussion with some of my far right friends, some of my far left friends. We can go to lunch afterwards. We may have raised our voice during that discussion, but we can all go to lunch. I can't do that in Dallas or Houston. And people go, really? I said, so there's a forgiveness here that I don't see in other cities. But there's not another metro like Austin. And I've done studies all over the United States, and I haven't seen anything that has or similar positively. Tulsa looks like us. They have a river going through, and they're pretty forgiving. But as far as dynamics, there really isn't.
I would totally agree with Mark. And to carry that maybe a little bit further even, and I'm probably going to sound like a Chamber of Commerce person here, but if you look at what Austin offers, the entertainment, the ACL and South by Southwest, and all the bands that are here all the time. I know a person that moved here from the middle part of America simply because of the music scene. And this is a person that has nothing to do with music. She just absolutely loves music. The hills, the trees, the lakes, the natural beauty, the outdoor life, the relatively temperate climate, last February being an outlier, I understand, but most of the time, and August and September, but yeah, I mean, most of the time it's relatively temperate. It's not Minneapolis, right? It's not Southern Florida. So the climate is great. We're outside a lot. We don't have high tax rates. Certainly not, we don't have, corporate and personal tax rates like California does. We're a fairly business friendly state. We don't have earthquakes that we can actually feel here. We're far enough from the coast that the hurricanes, except for Harvey, really don't get up here very often. Mostly what we get is hot air. There are a lot of things that we don't get the tornadoes that Tulsa gets and Oklahoma City gets. Yeah. So there are a lot of things, the natural disasters we don't get, but the natural environment we do get. And like Mark said, absolutely, we have a great business climate and a great personal climate and people that are forgiving and open.
Roland and Christine, do you want to weigh in on those comments as well?
I would add, it's a great question. It really depends on what segment of the market you're talking about. I think I agree with a lot with what Mark and Gaines said. I would also add that if you're looking at we travel a ton domestically and trying to do more global travel soon. And what I see, and Austin's great. Austin's a shining star. Austin's the poster child in a lot of ways. But at the same time, I fully realize there's a lot of competitive forces. There's a lot of beautiful parts of the country. I mean, I'm in Charleston right now. I was just in Savannah, Georgia, beautiful parts of the country. But I see, Austin's target, one of Austin's target market for real estate. Obviously, your companies, corporations, but I think it's a big part of Austin attractiveness is you have young, middle-aged or older creative, well-traveled, smart, well-educated folks that want to live somewhere in the country. And Austin, you know, I think we get our fair share of that market. But what I'm seeing are people that are coming to Austin for that. But I've also seen people move out of Austin and go to, you know, they love Austin, but they've had their great experiences here, and they're moving away for whatever reason for their next chapter. But I'm personally seeing Seattle, Denver, as big areas, and also the Research Triangle in North Carolina still. And then I just had a client move a few years ago away from Austin, and he's actually here in Charleston where I'm at. And so there's a lot of creative, cool areas, small, medium, and large urban areas that have been revitalized in an amazing way. I mean, I walk down a lot of Main Street, small, you know, on our road trips, small, very small towns to very big cities. I used to live in New York City in a previous life, but you know, everybody wants it. Every city has created a nice walkable urban district with really nice homes, great density, coffee shops, bakeries, etc. So Austin's, we're going to keep rocking and moving forward and attracting our fair share. But anyways, that's my long-winded way of saying there's probably 4 or 5 other cities that
I was going to say we're right at the 1:30, and I did, Christine, I know you didn't get to weigh in on that. I'm sorry. I did want to mention to everyone that we do have a survey for you to take. We just put the link in the chat, and I would like to thank our speakers again for sharing their great insight and wonderful discussion. Thank you to everyone for attending, and we really do want your feedback. It helps us plan future events. And as a reminder, everyone that registered will receive a follow-up email with these resource links and slides and a recording of the webinar. And all attendees that joined us for the webinar today will receive a continuing education certificate if you attended the entire event. And that is for self-reporting of GBCI CE hours and AICP CM credits. And if you provided your AIA number during registration, we will report your AIA LU for attending this webinar. So thank you again to everyone. I appreciate it, and we're so glad you joined us today.
Stay healthy. See ya.
Guys.
Thank you.